This is what always happens before a financial crisis. This graph has predicted every single recession for the last 80 years. Warren Buffett and Michael Burry have used this graph in order to predict the 2008 financial crisis and make billions of dollars. Wall Street, JP Morgan, BlackRock, all of them are watching these two graphs right now in order to find out whether we are on the brink of another recession. Predicting a recession seems impossible. Nobody knows the future. But what if I told you that there is a scientific way to do that? It's not an opinion, it's not some kind of a prediction, it's literally just pure math and science. In fact, it's not even a prediction. You can mathematically predict the next market crash and a recession if you know how this graph works. Hey, Proactive Thinker is here. I simplify investing, economics, and finance to help you become financially independent and build generational wealth. And in this video, we are going to talk about the yield curve and how we can use it to predict the next recession and how close we are to the next recession based on the yield curve. If you're ready, give this video a thumbs up and let's dive in. This is the yield curve. It plots interest rates of bonds with different maturities. A bond is the debt to raise money. Normally, long-term government bonds have a much higher interest rate than short-term government bonds, such as 3-month treasury bills or 2 years government bonds compared to the 10-year government bonds, because investors demand a much higher interest rate for locking their money for longer. If I return your money 10 years from now, you will demand a much higher interest rate because you're waiting for a longer period and you're taking a much higher risk than if I return your money next month. Therefore, the yield curve is positive sloped. The longer you keep your money, the higher is the interest rate. Understanding this concept is extremely important in order to understand how the economy works and for the economy to function properly. Long-term government bonds always must have a higher interest rate than short-term government bonds. The bond market is the heart of the economy. It's worth around $130 trillion globally, and it's the place where corporations, governments, and financial institutions raise so much money. When you hear all the time about the US government debt that is around $37 or $38 trillion, maybe by the end of this video it is going to be $45 trillion, all of that US government bonds. The bond market is the primary tool that the Federal Reserve is using in order to loan money to the government. Japan alone holds almost $1 trillion worth of government bonds. So any changes to the bond market is going to have very serious and direct implication on the economy and can help us to understand where the economy is headed to. This is how the yield curve predicts a recession. If the yield curve is sloped negatively, then a recession is almost going to happen. Wait a second, how is that even possible? How can a random graph predict a recession? It doesn't actually make sense or whatsoever. Let me explain. There are tens of trillions of dollars being invested. That is why Wall Street is, for example, so powerful, because they take all of that money and invest it. They move it from one place to another. Every day they could move not just hundreds of billions of dollars, but in some cases they move trillions of dollars. And there are two fundamental concepts of investing. What I would say, there are two main goals of investing. Number one, protect the wealth that you already have. Number two, grow that wealth. And in that priority. So the first thing you're thinking about is that how can I protect those trillions of dollars? Now, the easiest way to protect that wealth is to simply keep it in the bank and nobody's going to touch it. But the problem is that we have something called inflation, which means that every single year, the real value of that money goes down. The purchasing power of that money decreases, which is why you have to invest that money somehow, at least to get the return that inflation does. So if we have an inflation of 3%, you want that money to grow by at least 4% for that to make economic sense. Otherwise, a year from now, if you keep it in the bank, that $1 trillion worth much less than it used to be in the past. But if there is an opportunity to grow that wealth further, for example, to grow it by 6, 7, or 8%, you are going to do that only if the risks are minimal. Now, when you're investing $10,000, you don't really care much about that because it's just $10,000. However, if you're investing $10 trillion, then losing even a small percentage is really significant. So you're not ready to take that kind of a risk. You're only going to invest it when you're confident that the risks are absolutely minimal. Because at the end of the day, the primary goal of investing is to protect that wealth. So you have different asset classes: government bonds, gold, corporate bonds, the stock market, crypto, and the returns on all of these investments change depend on the circumstances and the state of the economy. When the economy is growing, you're more likely to invest in much riskier assets because you can predict the future. You can see that the economy is gradually growing and you're not afraid to take some little extra risk because you're not afraid that the market is going to tank tomorrow, which is why returns on the stock market suddenly increase because investors are pulling out trillions of dollars and investing in the stock market and sometimes even in crypto. But when the economy is shaky and it seems uncertain and you're not sure what is going to happen, like it's happening right now, investors are worried, they get nervous, suddenly they start pulling out their money from riskier investments and start investing in the most safest investments possible, such as US government bonds, especially long-term government bonds. Because if you're expecting a recession in the next year or so, you're going to lock up your money for the long-term investments that are the most safest in the market. But remember, in order for the economy to function properly, long-term government bonds must have a higher yield returns than short-term government bonds. However, when all investors are selling their investments and buying long-term government bonds, what is happening to the yields of those government bonds? They are going down. If the government sees that there is so much demand for the 10-year government bonds, suddenly they will start offering lower interest rate because everybody wants them. On the other hand, nobody's watching, nobody's buying the short-term government bonds, which is why the government is raising the interest rates for the short-term government bonds in order to attract investors to the short-term government bonds. Nobody is going to lock their money in a 10-year government bond expecting that the market is going to grow tomorrow and they can make astronomical returns. The only reason they are doing that is because they're expecting a recession. So when you see that dynamic is changing in the market, that basically means that investors are screaming that I will accept a lower return on 10-year government bonds for the sake of safety, if my money is protected, if I can protect my wealth, because I'm expecting a recession. But it gets even worse than that. When there is a period of high inflation, just like we have right now, then investors expect at least an interest rate that is higher than inflation slightly in order for the 10-year government bonds to make sense. But if they accept that, that means that investors are so desperate and they're expecting such a huge crisis that they're accepting that lower interest rate because they believe that a recession is going to happen and that recession is going to drive inflation down. During a recession, there is less spending, there is less loaning money to the corporations and the consumers, and less spending leads to lower inflation, which is why investors are accepting lower interest rate for 10-year government bonds. The inverted yield is the most reliable warning signal to find out if there is a recession coming. These are 3-month US Treasury bills. They have been growing since 2022, and currently they stand at 4.3%. But 10-year government bonds have fallen from 4.8% to 4.3%, indicating that investors are shifting their wealth from short-term government bonds into the long-term government bonds. And that is another reason why the stock market right now is collapsing, and it has been collapsing for the past month or so, because investors are selling their stocks and moving that money into the long-term government bonds. But here is the real problem, where the situation gets significantly worse and the recession becomes absolutely imminent. Banks are the backbone of any economy. The entire economy is simply based on lending and borrowing money. Take a look at your life. You have a mortgage. You got that money from the bank. You took an auto loan to buy that car. You have a credit card. The same thing goes with any corporation that you see. They're borrowing not just like millions of dollars. Some of them borrow hundreds of billions of dollars to make that business possible. So when the banking system becomes infunctional, that gets even worse. Banks borrow money at short-term rates and loan them at a long-term rates. So if short-term rates is, for example, 3% and long-term rates are 5%, they're making a 2% difference. They're pocketing the 2 difference. However, when that dynamic changes and short-term rates grow to 6%, for example, and long-term rates are 4%, suddenly it is unprofitable to do banking. I mean, borrowing and loaning money is unprofitable because you're borrowing at 6% and you can only loan it at 4%, which is why banks stop loaning money to people, banks stop loaning money to corporations, and spending goes down within the economy. and that triggers a recession. If we summarize everything, the yield curve signals a recession when long-term government bonds have a lower interest rate than short-term government bonds, because investors are afraid and they move their money into the long-term government bonds. And the current market condition indicates that we're about to face a recession. If you want to know more about how to protect yourself and how to profit from the next recession, then check out my program using the link in the description. That's it for today, guys. Thanks for watching, and I will see you in the next one.